Bank funding, retail vs wholesale. Welcome. While retail deposits provide a stable foundation, they are often insufficient for the massive scale of modern banking operations. This brings us to wholesale funds, which are funds borrowed from other financial institutions, central banks, and large corporations. Unlike retail deposits, which come from millions of small individual accounts, wholesale funding allows a bank to bridge significant liquidity gaps very quickly by accessing large pools of professional capital. It is an essential tool for managing a bank's balance sheet, especially when credit demand from borrowers outpaces the growth of local savings accounts. As the slide illustrates, financial institutions have larger financing needs than typical companies. We distinguish between retail deposits from individual customers and wholesale funds from the institutional market. The primary purpose of wholesale funding is to manage liquidity gaps efficiently. As a trainer, I want you to see wholesale funding as a scalable resource. If a bank suddenly needs to fund a multi-billion-dollar project, it cannot wait for new retail customers to walk through the door. It must turn to the wholesale markets to raise that capital in a single day. Types of wholesale funds. The wholesale market is categorized into three primary pillars. First are central bank funds, which involve banks lending their excess regulatory reserves to one another. Second are interbank funds, which are unsecured loans and deposits made directly between commercial banks. Third are certificates of deposit (CDs), specifically large denomination, negotiable instruments. Each of these sources plays a different role in a bank's daily liquidity strategy. While central bank funds are typically for overnight needs, interbank funds and CDs can provide funding for several months, helping the bank maintain a balanced and diversified maturity profile. The slide identifies the three main categories of wholesale capital. We have central bank funds for reserve management, interbank funds for unsecured lending, and certificates of deposit as negotiable instruments. As a professional, you should view these as a hierarchy of liquidity. A bank's treasurer will move between these three sources depending on the cost of interest and how long they need the money. Mastering the mix of these three types is what separates a well-managed bank from one that is vulnerable to sudden market shocks. Central bank funds. Central bank funds are the inner circle of the banking system. Most central banks require commercial banks to hold a minimum level of reserves. Naturally, some banks end up with excess reserves while others have a deficit. The banks with excess funds lend them to those in need, typically for a very short duration, usually just overnight. In the United States, this is famously known as the federal funds market, and the interest rate charged here is the Fed funds rate. This market is the primary channel through which a central bank's monetary policy influences the entire economy, as it sets the baseline cost of money for all other lending. The slide explains that banks with excess reserves lend to those with a deficit. These are overnight transactions that happen in the federal funds market in the US. As a trainer, I highlight that this is the heartbeat of the financial system. If the central bank wants to slow down the economy, it raises the target rate for these funds, making it more expensive for banks to borrow from each other. This immediately ripples out, raising interest rates for everyone from corporate borrowers to home buyers. Interbank funds. Moving beyond the central bank, we have the interbank funds market. This is a global network where banks place deposits with one another and take out loans to manage their daily cash positions. These maturities are longer than the overnight reserve market, ranging from overnight to 1 year. Crucially, these are unsecured transactions, meaning no collateral is pledged. Because of this, the interest rates in this market, such as the historical LIBOR or Euribor, are seen as a direct reflection of the perceived credit risk and health of the overall banking system. The slide defines the interbank market as the space for loans and deposits between banks. These are unsecured transactions with maturities up to 1 year. This market is the source of reference rates like LIBOR and Euribor. As an analyst, you must realize that when interbank rates spike, it's a sign that banks are becoming nervous about lending to each other. Because there is no collateral to fall back on, interbank lending relies entirely on mutual trust. When that trust wavers, the entire global flow of credit can begin to stall. Large denomination negotiable CDs. The third pillar is the negotiable certificate of deposit (CD). Unlike a standard retail CD, these are issued in large denominations, typically $1 million or more, and are aimed at institutional investors like money market funds. The negotiable part is key. It means the investor can sell the CD in the open market before it matures if they need cash. This provides the bank with a fixed amount of funding for a specified term and interest rate, while giving the investor a liquid tradable asset. It is a highly efficient way for a bank to lock in medium-term funding from the professional investment community. The slide describes these CDs as representing funds on deposit in large denominations. Their most important feature is that they are negotiable, meaning they can be sold in the open market. As a trainer, I want you to see these as a bridge between a deposit and a bond. They give the bank the certainty of a deposit, but offer the investor the flexibility of a tradable security. For a bank's treasurer, issuing negotiable CDs is a primary way to diversify the investor base beyond just other commercial banks. Risks of wholesale funding. While wholesale funding is scalable and efficient, it carries significant funding liquidity risk. Unlike retail deposits, which are sticky and driven by customer habits, wholesale funds are highly sensitive to market confidence. Professional lenders are flighty. If they perceive even a small increase in a bank's risk, they will immediately stop lending. We saw this clearly during the 2008 crisis, where the wholesale markets dried up almost overnight, leaving many banks unable to fund their daily operations. Relying too heavily on short-term wholesale markets is a dangerous strategy that requires very careful risk management. The slide warns of funding liquidity risk and the fact that these funds are sensitive to market confidence. In times of stress, banks may withdraw funding from each other. As a trainer, I emphasize that wholesale funding is a fair-weather friend. It is there when you don't need it, but it can vanish exactly when you need it most. This is why regulators now force banks to hold liquidity coverage ratios to ensure they have enough high-quality assets to survive if the wholesale markets ever freeze up again. Comparison: retail vs wholesale. To help you choose the right strategy, let's compare these two sources. Retail funding is lower cost and has much higher stability due to its stickiness, but it is operationally heavy to manage millions of accounts. Wholesale funding is higher cost and lower stability. It is flighty, but it is easily scalable. The bank can raise $500 million in the wholesale market with a few phone calls, whereas getting that much in retail deposits could take months of marketing. The most successful banks maintain a careful balance between these two to ensure both cost efficiency and survival. The comparison shows retail as low cost and higher stability, while wholesale is easily scalable but flighty. While retail is sticky, wholesale provides the quick accumulation of large funds. As a professional, you must look at a bank's net stable funding ratio. If a bank is using flighty, wholesale money to fund long-term, illiquid loans, they are taking a massive risk. The ideal bank structure uses retail for the core foundation and wholesale only as a tactical tool to manage temporary growth or gaps. Summary of wholesale funds. To summarize, wholesale funds are a critical component of a bank's liquidity management, allowing them to fund operations and manage gaps that retail deposits cannot cover. We explored the three main types: central bank funds, interbank funds, and negotiable CDs. While these sources provide essential scalability and access to capital, they also introduce significant liquidity risk during systemic crisis. A bank's treasurer must be a master of balancing these flighty professional funds against the sticky retail base to ensure the institution remains stable through all market cycles. Our final summary brings it all together. Wholesale funds provide bank liquidity. The three types are central bank, interbank, and CDs. They are easily scalable but carry higher liquidity risk during a crisis. As a trainer, I hope you leave this session understanding that wholesale funding is a powerful but sharp tool. Used correctly, it allows a bank to grow and serve its community. Used poorly, it can lead to a rapid collapse. Mastering these institutional flows is the key to understanding the true strength of any modern financial institution. Thank you.